Hello, Money Marvels. Welcome back to Finance with Ronke, the channel where we simplify personal finance, savings, and smart investing for everyday Nigerians. I am Ronke, an ex-banker, chartered stockbroker, and investment banker. My mission is simple, helping you take control of your money and make it work for you. Today, we are diving into one of the easiest and most affordable ways to start investing, which is the mutual funds. Whether you're just starting your financial journey or looking for smarter ways to grow your wealth, this video will guide you. In this video, we're going to be looking at why mutual funds could be the right option for you, mutual funds versus managing your own investment, the different types of mutual funds available, benefits and risks of investing in them, and the kinds of returns you can realistically expect. Stick with me till the end because this might just be the simplest step you will take towards achieving your short term, medium, and long term financial funds. And as always, don't forget to like, subscribe, and turn on notification buttons. Let's dive into the teaching. Mutual funds. Over the years, mutual funds have made a name for being one of the simplest and most affordable ways for individual investors to realize their short-term, medium, and long-term goals. Investing in a mutual fund is easy and rewarding, and by learning about them, a new investor is able to take the first step towards reaching their financial goals. So, what are mutual funds? A mutual fund is like a basket of different investments put together to form one asset group. You most likely cannot by yourself own a single share of stocks in hundreds of companies. Like you cannot own every stocks on the Nigerian Stock Exchange or the US Stock Exchange. So it's not possible. But by purchasing a unit or by purchasing units of mutual funds that hold all these securities, you can. So a mutual fund is like an investment vehicle that allows you, an investor, to combine your money with that of other investment investors seeking a similar investment outcome, and have a professional investment management manager use their skills to manage the money to achieve that stated outcome. So you have investment managers, and they combine their skills together to achieve that outcome. So the investment managers, you could trust them. So they invest in various instruments such as cash, treasury bills, bonds, equity, real estate, and so on and so forth. So it's just a pool of funds. So rather than you buying single stocks, you and several other investors, you take your money and pull it into the one place, and you get to buy all those stocks that you are hiding some stocks and you could not buy them, or you are looking at this very stocks, and it takes off the stress from you. And that's why you have mutual funds. So you invest together, you have a pool of funds together from numerous investors to invest in securities. And that's what the mutual fund is like. So you could just look at it that, oh, for example, let's say you like ice cream, and you like the strawberry ice cream, you like the vanilla, and you like this chocolate ice cream, and you are craving for all three ice creams. So instead of you to go into the maybe Cold Stone to buy all those three cones of ice cream, you could just opt for a cup of ice cream, whereby they mix all those ice creams together, and this is just the voila. You have just a cone of ice cream, and in there you have your chocolate, in there you have your vanilla, in there you have your strawberry, even you have a touch of mint flavor in that ice cream. So this is often the strategy that is being deployed in mutual funds, taking one cup of ice cream but different flavors. So it's just like you also wanted to have different kinds of fruits, and just for you not to be eating all those fruits, you could just have a fruit salad where inside you have purple, you have pineapple, you have banana, you have berries, blueberry, strawberry, all of those grapes inside that bowl of fruit salad. That is typically what a mutual fund is all about. So you save yourself the stress of buying individual stocks, and you give that job to fund managers because they pull the funds from all their clients and purchase all those investments on your behalf. That is basically what they do. So why mutual funds? Why do we invest in mutual funds? These are mutual funds are particularly good for retail investors like you and as because it gives access to professionally managed diversified portfolios of equities, bonds, and other securities. So you and I could have the same portfolios like all those big shots, like the corporate yeah, institutional investors. We could have the similar portfolio that mirrors what they are investing in. By that is how you can get access to that through the mutual funds. Also, mutual funds are also suitable for investors who have money but don't want to do the stressful work of investing in separate assets. You just want to save the stress of buying this stock, and buying like 20 stocks at the same time. And then you need to monitor, because that you can't just buy stocks and abandon them. You need to monitor them one after the other. So it saves you the stress of managing the paperwork of buying each one of them one after the other. This is being all done by the fund manager. Then they're also great for first time investors or people who just want a more seamless investing experience. This is where the fund manager is in charge of managing the performance of the bond. So it's mutual fund offers you an easy, low maintenance way to diversify investment without the complexity of picking individual stocks. Or you pick Dangote, you pick MTN, you pick Boafos, Honeywell, Flour Mills, and you're just picking and picking and picking. It saves you the stress. If you can't decide which stock to buy, and you're just overwhelmed with what is happening, and like, which one should I buy? Buy a mutual fund or an ETF. So we look at the types of mutual funds. The majority of mutual funds fall into one of the following five categories. There are five categories of mutual fund. So we have the stock, which is also known as the equity fund. It's just they invest in the shares of organization and companies in a diversified manner. Instead of you buying um Zenith Bank, GTB, Dangote, MTN, Honeywell, Seplat, Aradel, and all that, you could just buy an equity. Maybe you could just look for an equity fund that some of them invest in small cap companies, some of them invest in mid cap companies, and some of them invest in large cap or good focus on companies. So it depends on what you are looking at. Some will look at growth, some will look at income. So it depends on your investment goal. So you just go into that. And some of them, there's an ETF that attracts the top 30 stocks on the Nigerian Stock Exchange. You could just buy it, and in it you have all the 30 stocks, but the top 30 stocks on the Nigerian Stock Exchange by just buying one mutual fund. So for growth, you could concentrate on stocks with potential for above average financial returns, but they might not pay you regular income. So if you are looking at income, just income, you go for income based mutual funds. And then money market we have the money market. These funds, they have comparatively low risk because they only invest in a select group of high quality short term securities issued by corporations and the government. So short term securities like treasury bills, fixed deposits, commercial papers. These are money market funds. So when you hear about money market fund, so you know that you are investing in treasury bills, you are at the same time investing in commercial papers, and you're investing in federal government savings bonds. That is money market. It's a type of mutual funds. Then we have the bond fund, or you have the fixed income mutual fund. So a fixed income mutual fund focuses on investment that pay a set rate of return, such as government bonds, corporate bonds, or other debt instruments. So they invest a bond fund, like the name implies, invest mainly in bonds. So and they often strive to earn better returns because they have higher risks than money market fund. The money market fund is a low risk investment vehicle. If you are scared of risk, you just want to, as in, you don't want any stress, you just want your money to grow, and then you don't want to be palpitating about your investment, you go for the money market. But if you want a higher risk, you can go for the bond fund. So the risk and return of bond funds may vary because of the diverse range of bonds. So the risks, we have different kinds of bond funds also under this one. Then if you are that high risk person, you can go for the equity fund because it's stock market and they offer higher return compared to the bond fund and the money market fund. Then we have the balanced mutual fund. This one, they invest in a hybrid of asset classes. So you could have the money market instrument inside it. You could have a bit of stocks inside it. You could have a bit of bonds inside it, or alternative investment like gold, real estate, and all that. And then with the objective of reducing the risks of exposure across asset classes. So there is a way that they are going to classify so that it's, yeah, they are not overly exposed to a particular asset class. So it is well balanced. It is balanced, why it's called balanced mutual fund. Then we have the index funds. They are also a type of mutual fund or exchange traded fund with portfolio designed to replicate or follow the characteristics of a financial market. For example, we have the S&P mutual fund, S&P 500, or the NGS 30. So these ones, they mirror, this index fund, they mirror the performance of a set of organizational stocks. So it's just that it's considered to be low operating cost because it has a broad market exposure and minimum portfolio turnover. So it is quite good if you are looking at, maybe you want to invest in all the 30 stocks, the top 30 stocks on the NGS. Instead of you buying the individual 30 stocks, you can just buy the NGX 30. We have the NGS 40 also. So we can just buy the NGS 30. We have the banking stock. We have an index fund that tracks banking stocks on the Nigeria Stock Exchange. So instead of you buying Zenith, buying GTB, Fidelity, Wema, ETI, Eco British, Eco Bank, buying all those stocks, you could just buy the banking stock index fund, and it tracks all the banking stocks, and just you get the same return that you'd have gotten. And one of the advantages that if you have that index fund, for example, if you have maybe like four stocks in that index fund, then you have GTB, you have Zenith, you have Fidelity, and then maybe you have Sterling Bank, four banks in that index fund. If and then compared to somebody that has individual stocks of those banks. So we want to look at those two scenarios. You have four stocks, four different banking stocks, and then there's another person that has the index fund tracking four stocks. So if you lose in GTB, and maybe the price of GTB goes down and it drops your portfolio, but if you compare it with that of the index fund, if that index fund is doing well, if GTB drops and the Zenith Bank is doing well, EcoBank is doing well, Fidelity is doing well, Sterling Bank is doing well, it will average up, and then you will not really feel the impact of GTB dropping so much, or as against you just having only GTB stock in your portfolio. So that is the essence of the individual stocks versus investing in mutual funds, and how they trade. They are unlike the stocks that trade all day between the hours of 10 a.m. to 2:30 p.m. Mondays to Friday. Mutual funds trade only once daily after market close. So it's after the market closes that you get to trade on mutual funds, and it trades only once a day, not for the period of like 5 hours, 30 minutes that you can trade on the Nigerian Stock Exchange. And the price is set by net asset value at the end of the day. So you get your price set through that. Then, so what are the benefits of investing in mutual funds? So why should you invest in mutual funds, or why do people buy into mutual funds? So with the wide number of investment solutions available on the market, you might wonder what makes a mutual fund so special. Number one reason is that it is professionally managed. That means it's a hands-off approach. So for beginners, managing a diverse portfolio of stocks and bonds can feel overwhelming. You have like 15 stocks, you have 12 stocks, you have 13, and tracking them could be overwhelming. So mutual funds provides a hands-off approach, allowing investors to leave the decision making to the experts or follow a market index. So with just one investment, you gain exposure to a variety of assets, which simplifies the investment process. So it is the fund managers that will do the research for you. It is the fund manager that will select the securities and actively monitor the performance. So it can really be a stressful thing for you to be monitoring, for you to be doing research, and then you are also investing at the same time. So an avenue for you to save your stress because it's professionally managed. Then another benefit is diversification. Mutual funds provides diversification, meaning your investment is spread across a variety of assets, which means there is a low chance of you recording losses if there is a decline in some of the stocks. So this helps you to lower your risk exposure, as the performance of the fund isn't dependent on any one asset. If one asset is going down and the other assets are doing well, you will not feel the impact as against you just owning that individual stock or asset. So that is the essence of diversification. So, but it could be very tricky because investing in multiple assets as a beginner can be tricky because you really don't know which and which to go for. That's why mutual funds are the most recommended for beginners because they come diversified. You don't need to worry yourself because if you're investing in individual, so you're like, okay, let me invest in consumer goods, let me invest in industrial sector, let me do communication, let me do healthcare, let me do banking. Do you understand? Let me do oil and gas. And you're looking at those sectors and you're investing in them. It could be overwhelming and very stressful for you. But with a mutual fund, a one unit of mutual fund that you buy, you have all the stocks diversified in that unit of mutual funds. So it's just like you don't put all your eggs in one basket. That is what it means you are diversified. Then affordability, which is cost efficiency. Most mutual funds set a relatively low amount for initial investment and subsequent purchases. There is really a low entry with mutual funds, some as low as 5,000 naira, as against maybe you are investing in commercial paper where they say the minimum investment is 5 million. Do you get? But with mutual fund, you can have access to a commercial paper, maybe through the money market fund, and then bond, treasury bills rather, fixed deposits, and you get a mutual fund, money market mutual fund, and you have access to it. So it's really very strict. It's very, very relatively cheap because there is strength in numbers. You have a pool of funds put together, and then they could have maybe 20 million, 500 million, and they could buy into that commercial papers, but your own contribution is just 5,000 naira out of the pool of 500 million or something. So it's quite affordable. Then liquidity, it can be redeemed at any time. As an investor, if you have a pressing financial needs or a pressing financial need, mutual funds are liquid enough for you to sell the unit and get the funds in the next, maybe by the next day or in 2 days time. And the return could be low, especially if the funds were liquidated before time, and maybe the fund is experiencing a loss. But you could have access to your funds online. Maybe you are dealing in real estate. In real time, it's very liquid. Then dividend reinvestment, your investment compounds when your dividends and other interest earnings are invested into the mutual fund, and you can leverage your returns to purchase more units. So that is what is called reinvestment. And there is power. There is the eighth wonder of the world of this world is compound interest. When your interest keep working for you and your interest keep earning interest and you keep compounding it. So mutual funds give you that opportunity to compound your dividend or your interest. Then we also have daily pricing. Mutual funds are priced daily, so you always know the value of your investment. So maybe you invested from the 1st of August, and by the 15th of August, you know what the value of the interest you have earned on that investment is already at by the 15th. So it is priced daily, so you know the value or the worth of your portfolio. Then the objectives are this are is safe. Your capital is safe. That is one thing, safety of capital. And then income, aim for a steady dividends or interest. You have your income guarantee safe also, because every mutual fund, their aim is for steady dividends or interest depending on the kind of fund you are buying into. And then there is growth for you. That's another objective, aim for capital appreciation over the long term. Those are the objectives of mutual fund. So we now go into the risks of mutual fund investing. Number one is returns might be low. You might make less with mutual funds than you would if you decide to invest in a single stock, provided the stock performs really well, especially if you invest the very minimum, like those that invested. There was this recent insurance stock bull run those people that invested, a lot of people were able to make so much money from it. But if you had invested in money mutual funds, you might not have recovered or realized that kind of gains from the individual stocks of insurance and penny stock that you someone else got. So the returns might be low. Another risk is over diversification. One of the key benefits of a mutual fund is that is frequently mentioned is diversification. However, there is always the possibility of over diversification by the fund managers. So this is another thing that could be a disadvantage, and this could erode the relative benefits of diversification. Then you lack control. You are not fully in control. This is a pro and a con. If you are someone who likes to monitor the market activity, then you should have fewer mutual funds because the fund managers are in charge and not you. Is an hands-off approach. You are not in control. You cannot dictate what to buy. You cannot say buy this for me. They invest the money, whatever amount you give to them is their sole responsibility to invest the money with their own according to how they've been able to research the market. The manager's risks. Any fund manager's performance is based on the manager's experience, their knowledge, the skill, and investment techniques or process. So if any of these factors are lacking, to negatively impact the fund's performance and hurt unit holder. So when you are trying to buy a mutual fund, try to look at the track record of the fund manager. What have they done before? What is their current net asset value really like? So you ask those questions because if a fund manager is not doing well and you commit your funds into that kind of fund manager, you are at a risk of losing of not getting enough returns or enough value from your investment. Then we have the market risks. So this could be in response to market and economic conditions, regional or global economic instability, like the time of when we had COVID, or currency or interest rate fluctuation. So the prices of income generated by company asset may decrease. So depending on whatever is happening, maybe in the global economy or in the local or national economy. Then we have the investment cost of fees. Majority of mutual funds require a minimum investment of a naira or dollars before you can opt in to buy shares or a fixed amount of the fund. So each of them, there is a certain amount that is required of you. The fund manager, you are supposed to pay fees that you need to for them being in charge or managing your funds. So it varies. This is something you need to look at. Look at their fees, look at their cost structure, and then you go for the cheapest. That is how to maximize your funds. So what are the things to consider as a mutual fund beginner? So number one is research. Before plunging into stock market, every beginner should do thorough research. So know the different types of mutual funds, and we have already discussed them and their pros and their cons. Then know your goal. What are you investing for? Are you looking to build wealth or make quick bucks? It depends on what you are doing. So while mutual funds can help you to build wealth, you need patience and regularly topping your investment and allowing your returns to compound over the years. So it depends on your goal, then that will help you. Once you are able to know your goal, maybe you are saving towards retirement, you're investing towards retirement, you're investing towards children's education, getting your own home or anything. You need to know your goal and then you compound the interest, and that will help you to go a long way. Then identify your risk tolerance. This is the amount of loss an investor is willing to take on when making an investment decision. That is what is called risk tolerance. And we have three types of risk tolerance: your ability to take risks. We have people that are very aggressive. They can go out to take risks, and we have those people that are moderate in risk taking, and we have the conservative ones. And you need to know which one are you, whether you're a risk taker, you're a conservative person when it comes to taking risks, or you are moderate. If you are conservative when it comes to taking risks, don't go for the equity fund, don't go for the stock fund. Stick with money market mutual funds. That is how to identify your risk. But if you are very aggressive, you can you can go into stock or equity funds because they have high returns and the risk is quite high. So you must know, are you okay? If you are okay with losing money or you are conscious about losing money, so there are some types of mutual funds that you cannot go into as a beginner. Then we have a exit load. So if you decide to exit the investment within just a few days of investing, or before the investment has even done anything substantial. So you might be charged an exit load fee. So you need to know what the exit load fee is, because it's also a risk to you. Then starting your investing journey. So how do you start your mutual fund investing journey? Understand, number one, understand what are mutual funds. We have done it. We have the bond mutual fund, we have the money market mutual fund, we have the fixed income, we have the balance fund, and we have the index fund. So understand what they are. Then you can, number two, contact your fund manager. You could contact First Bank, FBN, Quest, that is First Bank of Nigeria, Quest, or Stanbic IBTC. You can also use investment apps. We have a investment apps like CarryWise. On CarryWise, you can invest in mutual funds with as low as 1,000 naira. We have Niger One. We have a lot of apps that they do Mary Stem. They do invest mutual funds. Even some of them do dollar mutual funds. So you might not necessarily go to the bank. You can also use your investment apps to invest in mutual funds. Then create your if you're using an investment app, you create an account or sign into your existing account. You fund your wallet, tap invest, and then you choose your preferred mutual fund option. Are you going for the money market? Must be able to know the difference. Under each of the investment, you have the fund fact and what the fund is all about. Try and read what the fund is all about. Don't just click invest. Read it. Okay, this one is investing in bond. Oh, this one is investing in strictly stocks, or this one is a balanced fund. That means it invests in stocks, bonds, and money market. So you must know. So you then choose the one that aligns with your investment goals and your risk profile. It is very key. Your risk profile and your investment goal. You must pick the one that with aligns with that.